Hello everybody, welcome to episode 4 of M&A Demystified. In the previous episode, we talked about target identification and search process as well as some initial legal considerations in an M&A process. In this episode, we're going to talk about key valuation techniques used in the target valuation. So let's get started. Before we jump into the valuation techniques, let's discuss briefly the difference between value and price, and if they are the same. In an ideal world, you would pay for an asset or a company based on what it is worth. However, in real world, the price you pay depends very much on the economic and market conditions. For example, Lehman Brothers got sold for $250 million in cash back in the panicked market of 2008, despite its huge book of business and customers, while Facebook bought WhatsApp for $19 billion in the exuberant market of 2014, despite its very minimal revenue. Another reason you would see buyers paying a premium for targets is because of what it is worth to them. This is typically referred to as synergies, which we'll discuss in the next episode. But generally, while value is the key consideration in the determination of the price, they are not necessarily same all the time. So what are the valuation techniques that are used? While there are several, the top 3 techniques that are used are 1. Comparable company analysis, 2. Comparable transaction analysis, and number 3. Discounted cash flow analysis, or referred to as DCF analysis in short. In this episode, we are going to focus on comparable company analysis. The fundamental concept behind a comparable company analysis is that market ascribes similar valuation to similar businesses. So how do you go about doing this? There are 3 key steps. Step 1 is to identify companies that are similar to your target. This group is usually referred to as the peer group. No 2 companies are identical, and since you're basing the value of your target on this peer group, the selection becomes critical. So how do you select this peer group? You start with a list of public companies in an industry similar to that of the target and narrow it down based on size and growth characteristics as well as similar business models. The reason you pick public companies is because they have the most transparent valuations. While stock price may not always reflect the true value of the company, it is the best metric available and is a good starting point without going into deeper analysis. There are several databases available such as S&P Global, Capital IQ that will help you narrow down this list based on the criteria that you select. Some other good resources are sell-side analyst reports as well as competitors' annual reports or investor presentations that are typically available on their websites. The next question is, how many companies do you pick? While there is no formal requirement, 5 to 10 companies would form a good representative of the group. Let's say you picked 5 companies, then you go get the equity value of those based on their stock price and the number of shares. Then you add the net debt of the company to get to their enterprise value. Once you have the enterprise value of the public companies, then we move into the next step of the analysis, which is calculating the valuation multiple. A valuation multiple is nothing but expressing the value of the company as a multiple of either revenue or earnings or some other metric that is representative of that particular sector or industry. For example, you say company X is 2 times revenue or 10 times earnings. So it is the revenue multiple becomes 2x and the earnings multiple becomes 10x. While revenue and earnings multiples are the most common ones, there are some industry specific multiples as well. For example, in gold mining or oil production industries, enterprise value is often expressed as a multiple of reserves. And in social media companies, enterprise value is expressed as a multiple of monthly active users, which is what explains the high valuations of companies like WhatsApp or Snapchat despite losses, because they have a huge user base and the metric used is the monthly active users. And some of you who are active in the stock markets may have heard of price to earnings or PE multiple. This focuses mostly on equity and ignores debt, and as such is common in industries that have very little debt. Each valuation multiple has its own advantages and disadvantages. For example, if you're looking at earnings multiple, you need to carefully consider quality of earnings. What do I mean by that? In a given year, a company might have incurred a huge loss due to an unusual litigation, or it must have achieved huge gains due to selling one of its buildings. These kind of items are non-recurring and are not expected to occur in a typical year. So you would adjust those and arrive at a normalized earnings, which are then used for comparability. Also, different firms use different accounting methodologies for depreciation, amortization, which might cause issues with comparability. As such, it might seem like using revenue, which has little adjustments, might be a good starting point, but just looking at revenue and ignoring profitability doesn't always help. So there is definitely judgment involved in identifying the right valuation metric. But once you identified the metric and calculated the various valuation multiples for these companies, then we go into step 3, which is selecting the appropriate multiple to apply to your company's financial metric, which is either revenue or earnings. So let's say you've calculated the earnings multiple for the 5 public companies that you have chosen as the peer group, and the earnings multiple is in the range of 10 to 15x. Now, how do you select the multiple to apply to your target company's earnings? Would it be 10 or 12.5 or 15 or some number in between? Again, there is judgment involved here, but your selection is typically guided by 3 key characteristics, which are growth, profitability, and risk of your target compared to that of the public companies. So let's say the growth of your target company in the last 2 to 3 years was higher than the growth of any of those public companies. However, the profitability is about the average of that of the public companies. Then you would likely choose a multiple that is in between the average and the top end. So that would be somewhere in between 12.5 and 15. So a 13 or a 14 multiple. Again, the financials of the target company and that of the comparable companies would be a good guide here in selecting the final multiple to be used. Another consideration in selection of the multiple is whether you would look at the forward, which is the next 12 months earnings, or LTM, which is the last 12 months earnings. Here you would look at industry and economic cycles to make the selection. For example, a lot of the businesses were affected in 2020, so looking at the last 12 months earnings may not be the best determinant of the future potential earnings of the companies. So in those cases, looking at the next 12 months earnings may be more appropriate. So let's say you've selected earnings multiple of 13x. Now you would use this to multiply with the earnings of your target company to arrive at the enterprise value of your target. So that concludes our today's episode on comparable company analysis. Since there is a lot of judgment involved, these methodologies are typically not used in isolation, but in combination with other valuation techniques, which we're going to discuss in more detail in the next episode. Till then, have a great week and stay tuned in.